Alright, now for Chapter 13, Part 2. So where we left off at rental activities. So in general, rental activities are always passive activities. Okay? Unless you have, we have a few exceptions here. So let's talk about the real estate professional. So that's if more than one half of time is devoted in real estate activities, and they spend over 750 hours per year in the activity. Alright, so that's one, and then apart from that, they've got some other ones that are exceptions, like fewer than 7 days rented. So that's one. Some other ones. Average 30 days or fewer. Or with significant professional or personal services. So what would be an example of that? Well, in your book they're talking about like, for instance, if they rent a large crane and they have to have an operator with it, so like or renting a plane and the plane has to be rented with a pilot, that would be an example of personal services. And then extraordinary personal services. So they use the example of the hospital, where you're renting a hospital room, but the main reason you're there is for the services that are being provided in the room. And then incidental is just some like miscellaneous rental activity that might happen in a business, like renting office space in a corporation. Maybe their main line of business, or in a partnership, maybe the main line of business is selling something, and then they rent some spare office space in their building. Maybe they sell and manufacture something, and then just rent some spare office space. So that I would think of as incidental. It's not a significant portion of the business. And then they've got non-exclusive, which is like rented during certain business hours. Like they use the example of the golf cart on a golf course. So it's not exclusive to that customer. Other people might rent it, and they don't have access to it during non-business hours. And then the last one is if you own an interest in a business and you rent property to that business. So you send a partnership. S corp or joint venture. Okay. Alright, so let's think of another example. So David owns a hold on a second. Okay, well actually let's not do that yet. Let's talk about the $25,000 offset real quick. So if you look in your book, they have a $25,000 what they call an offset. Okay, so basically An example of this would be like if you had a rental home that you're renting out and you were doing all the management of the property, like you were taking care of, managing it, the, contracted maintenance workers and stuff like that for repairs, and you were overseeing it, like you hadn't contracted it out to a management company. You also take care of all the accounting related to the rental property. So you got active participation. So the IRS allows you to take up to a $25,000 loss against your active or portfolio income rather than only against passive income. Okay, so they let you do that. However, there is a phase out. You have to own at least 10% of the property. Okay, so you own at least 10%, you actively participate, and let's see, there's in addition to the stipulation, there's a phase out. So anytime you have AGI in excess of 100 grand, you're gonna lose 50 cents on the dollar. So when your AGI gets up to 150,000, you have lost that deduction completely. So between 100,000 of AGI and 150,000 of AGI, you start losing it. Alright. Okay. Alright, let's do this example. So we have David with AGI of 115,000. He owns a beach rental property in North Carolina in which he actively participates. The condo produced an $18,000 loss, and David has no other passive income or losses. So he has no passive income. So normally, if rental is a passive activity, he normally could not benefit from that loss. But with this $25,000 offset, the special rule, he can benefit from it. So it looks like he owns 100%, so he has the 10% test met. But he is over 100,000, so he's going to lose a portion of the 25. So we take 115,000 minus the 100K. We end up with 15,000, and then we have to multiply that by 50%, or 50 cents on the dollar. So this is how much of his deduction is phased out. So of that $18,000 loss, he's going to lose 7,500 of it, as far as the deduction is concerned, to the phase-out limitation. So he's only going to be able to deduct 10,500 against his active or portfolio income. All right. Oh crud. Alright, actually I made a mistake. I'm sorry, I didn't mean to do it. Okay, Lord. I shouldn't have started at the 18. I should have started at the 25. So of the total offset he can possibly take, he's going to lose 7,500 of that. So he has still 17,500. So of the 18,000, he can take 17,500, and the remaining 500 is going to be suspended and carried forward. To future years so if he has enough AGI next year to absorb it, then then he can benefit from that last $500. Alright, moving right along, and I hope we will. Okay, last thing is if we dispose of a passive activity. So here in your book they have disposition. Okay, so if you actually shut it down and get rid of it, so you're no longer going to generate any activity in it, and it's not going to make money, it's not going to lose money anymore, that is when you can actually utilize the pent-up passive losses that have carried over. So say you had an activity that just kept losing money, and it was the only passive activity you had. Okay, so you never ever had any passive income to take those losses against. Well, since you're going to shut it down, you're like, look, this passive activity is never going to make me any money, and I don't have time to set up another activity that could possibly make money, so I'm going to just go ahead and shut this down, cut my losses, quit while I'm ahead, or quit while I'm down. Just put a stop loss on this, and so at that point, I can actually benefit from those losses that I've never been able to deduct. Okay, so the activity's shut down completely. Any losses that have carried over as passive, I can offset against active income now, or non-passive. All right. So that's it. Yeah, that's passive. And I want you to skip the part about the at-risk and passive activity losses in conjunction. Okay, so that's where they do an elaborate dance with each other. I'm not too concerned about y'all knowing that stuff even kind of confuses me. But it's where they do this delicate ballet where, okay, well, some of the loss was disallowed due to passive and some of it was disallowed due to at-risk, and, how does that come into play? So don't worry about that. We'll go and talk briefly about alternative minimum tax now. AMT. Okay, so essentially, the way AMT works is there's two sets of rules. So basically we have regular tax rules, which is everything we've been studying up to now. And then we have the alternative minimum tax rules. And what you do is you calculate the tax under either set of rules and you take the greater of the two. Okay, so tax paid equals the greater of these two. So you calculate, okay, what would my tax be under the regular tax rules? And that's what we've been calculating up to now. Okay, what's the tax that we have to pay on our return? And then we do another calculation under the alternative minimum tax rules, and if whichever one's higher is what we're ultimately going to pay. Okay, so this is what we call the direct approach, where you do two independent calculations. Okay, the tax return and formulas don't work that way. The way the tax return operates is it says, okay, here is your regular taxable income. Okay, and that's under the normal rules. And you calculate the tax accordingly. But then, under the AMT rules, with the indirect approach, we do positive and negative adjustments. Okay, and then that ends up with our alternative minimum tax income. And then they've got an alternative minimum tax exemption. And we have an alternative minimum tax base amount, and then we calculate it with the tax rates, and that'll give us our tentative AMT, and then we subtract from that our regular tax as calculated with the normal rules, and the net of those two is our actual AMT. Okay, and so this amount gives this amount gives us the additional amount that has to be paid. So if you get a positive number, that means on the return an alternative minimum tax is going to show up. And then if you get a negative number, then that tells us, alright, well, the regular tax is higher, so we don't have to worry about AMT at this point. Alright. And that's it. So why the heck do we have this? Alright, well, so we have all these deductions, right? So previously we were able to deduct, state income taxes, property taxes, sales tax. We were able to deduct all these different things that are basically where all you have to basically do is spend money. Okay, so a lot of rich people back in the day, quote unquote rich people, I guess, were just they have millions and millions of dollars, and they're like, you know what, I'm just going to spend my millions and millions and millions, or maybe billions, and when I spend money, it's going to help me generate income tax deductions, and I won't have to pay any income tax at all, because it completely zero out my income. So you buy a huge house, and you have, buku property taxes that you're going to have to pay on that house. So that would be deducted against your income. Other things like, buying huge big ticket items on which you'd have to pay a lot of sales tax. And then you get to deduct the sales tax on top of your property taxes. And then you, on top of the house, let's say, okay, well, I know mortgage interest is deductible, so I'm going to, take out some debt and mortgage this house instead of paying cash for it. So now I have mortgage interest that I can also take as a deduction. So all these deductions, they end up zeroing out my income, and I don't have any income tax. So the government's like, you know what? That's not right. Rich people should not be able to spend their way out of the income tax. So they came up with this new set of rules several decades ago that basically disallows the taxes. So it doesn't let you deduct any taxes, and it also doesn't let you have any miscellaneous deductions, and then it has some other differences as well, as far as like depreciation. It's got a different depreciation table, and some other items. But the big thing is the taxes. Okay, so the taxes isn't really that big of an issue anymore because everybody is limited on how much taxes they can deduct anyway. So under the tax reform, taxes are limited to $10,000. So even if you buy a huge house and you have to pay a lot more in property taxes than that, you're not going to be able to benefit from it. So it's not as big of an issue as it was prior to the tax reform. Now, when the tax reform expires, 2025, it could be a huge issue again, just depending on what they do with the tax law over the next several years. So that's basically it. On alternative minimum tax. So for your exam, just know the items that are not deductible for AMT, like the positive adjustments, essentially. I'm not concerned with you knowing too much about this. Like, I'm not concerned, like I'm seeing in the textbook stuff about real property placed into service after 1998, real personal property placed into service after 86 and before 1999. Okay, all that incentive stock options, that stuff will not show up on your exam. So you might see like a tiny quiz question or maybe a homework question that might ask about some of that, and if you do, just let me know, and I'll try to clarify it. But as far as your exam, it's not very heavy at all on alternative minimum tax. Okay, so I hope this was eye-opening, and I hope you're having a wonderful semester. Talk to you soon. Bye.